shares of Oracle are moving higher pre-market after the company beat expectations on the top and bottom lines as it makes a play for the cloud computing market. You could argue they've been making that play. The company brought in $15.9 billion in revenue for its fiscal fourth quarter, with $6.7 billion of that coming from cloud services here. Cloud sales rose 27% year over year in the quarter, and Oracle expects that number to grow 70% in fiscal year 2026. I want to bring in Dan Morgan, who is the Synovus VP and Senior Portfolio Manager. Good to have you here. Good to see you this morning. Just take us into your reaction from the print from Oracle and what the company was saying with regard to its growth prospects.
Yeah, I think that's what really lifted the stock, Brad, was we have to bear in mind that Oracle over the last 10 quarters has missed 7 times, and they missed the last 2 prints. So this fourth quarter 25 number coming in above expectations was obviously well received. And then, like you alluded to, is really the guidance that they gave going forward. I mean, some of the things that really stood out to me, you mentioned cloud infrastructure as a service. They're expecting that growth rate to go from 52% to about 70%. They're actually looking to double the number of data centers, multi-cloud data centers, from 23 to 47. So I think it was, Brad, the guidance that Oracle gave going forward for fiscal year 26 that got everybody really excited in terms of the future growth of the company and appreciation for the stock price.
You know, as investors try to consider and evaluate the safest non-chip AI play, as we hear results from companies like Oracle and other software, CRM, ERP companies like Salesforce, SAP, are they trying to solidify themselves, position themselves as the next best additive to portfolios and the play for generative AI in the future that all of them are trying to power forward with agents?
Yeah, so Brad, if you think about the chip makers like NVIDIA and Broadcom and Intel and Marvel, of course, that is a heavy AI play in terms of growth. And everyone gets worried, right? Because, you see the headlines, PCs and smartphones, tariffs and all these other things. But then you kind of switch gear over to like an Oracle. You got to bear in mind that about 45% of the relational database market they control. They have over 400,000 customers. They're also a major player in enterprise resource planning. And now they've geared over towards competing against, let's say, Microsoft and Azure or GCP out of Google or AWS out of Amazon in the cloud space. So they're not as reliant or as susceptible to potential increase in tariffs on hardware like smartphone and chips. Now, bear in mind, Brad, they're talking about these huge build-outs that they're going to do in terms of data center. They're also saying that they're going to require $40 billion of GPUs that will most likely come from NVIDIA. So they are susceptible to a certain level in terms of supply constraints with components to build out these data centers. But they seem to be in a better position when we think of AI than, let's say, some of the chip makers who are so reliant on manufacturing in China and the Pacific Rim, who obviously would be devastatingly impacted by tariffs.
Dan, I only got about 15 seconds left here. We've talked a lot about valuation over the course of this week and how many companies have gotten ahead of their skis. Where does Oracle sit within that capacity and mind frame?
Well, just real quick, Brad, they traded about 25, 26 times earnings, pretty much in line with their historical level. So they're really not overvalued like you would think of as a really high PE multiple tech stock. So they're pretty much in line with their historical levels.
Dan, good to see you this morning. Thanks so much for taking the time.